the intake from the international market, which I believe is slightly margin accretive. And we are also seeing fundamentally the losses narrowing down for Hyderabad Metro. I think the performance can improve, and multiple re-rating can also happen, as we discussed last time. I was at 22x FY25 numbers. So definitely, I think there should be a strong move in the stock in medium to long term.
Thanks a lot for joining us. Appreciate your thoughts. Let's do one thing. Let's get straight to the market opening now. Yesterday was a big day for the market. We hit that milestone of 20,000. And guess what? We are on track to put in some more gains today, 100 points higher in the pre-opening. So looks like the bulls have not only tightened their grip, but are running with it really this morning. What's leading from the front is, of course, banks have come back in a big way. There's also capital goods. So there's the first tick on the index, standing tall above that 20,000 mark, 90 points higher on the Nifty now. The Sensex is up over 300 points and inching closer to that 68,000 mark. So 67,400 on the Sensex as well. The mid-cap index is up 200 points. So anything and everything is running. There's no question about that. The Bank Nifty is up about 160 points. As we call it, a secular run on the market today. What's leading from the front is L&T, up 2.5% on the back of news flow. There's Power Grid, there is Tata Steel, ICICI Bank. In fact, steel has come back in a big way. Tata Steel, JSW Steel are all in the green. ICICI Bank is your big mover now, almost inching towards the 1,000 rupee mark. Infosys is back close to 1,500. Sun Pharma are back at about 1150 or so. So big gainers actually across the board in the market. What's on the losing end? Perhaps a little bit of underperformance from FMCG. HUL, Nestle, Britannia in the red. Reliance is absolutely flat, continues its underperformance compared to the market, while something like an IndusInd Bank is down almost about 0.2% at the moment. So, just keep an eye out on that. In fact, my colleague Hormuz was telling me that the Nifty has taken 6 years from 10,000 to 20,000, and only 3 stocks during that period have given you negative returns. Hero, BPCL and IndusInd Bank. So these are 3 stocks that have seen huge underperformance in Nifty's journey from 10,000 to 20,000. But otherwise, very strong opening and lots happening in the broader market.
Well, that's right, Sonia. I think we should pull up steel strips and wheels. That stock, in fact, was higher in pre-open. There's an ADD that's been imposed on imports coming in from China. I think that's read positively. Remember, overnight, you had this fear that the talk was that it was on steel, but actually it's on, not on steel, but it's on steel strips. That's why, in fact, you've seen a big up move out there. Pull up Wheels India as well. I don't know how much volume trades out there, but both these two, they're the big movers in early morning trade. A couple of other notable movers. You have Union Bank that's up close around 3%, massive volumes out there. Torrent Power, yesterday the stock was under some pressure. The problem was that, in fact, the street believed that if they have to go ahead and do the deal with Cipla, the promoter entity will pledge their shares. Now they've clarified that that's unlikely to happen. So that's why that stock has popped up in trade. Amara Raja as well is up close to around 2%. A couple of other big movers from the broader market. You have IRFC that continues its big run. ITI, yesterday was up 10%. Today it's up another 9%. NIIT, that's up close to around 15%. And railway-related players, they just continue to chug along. You have IRCON that's up. You have a couple of other notable movers. IRFC, I already mentioned that one. But it's a good-looking screen. And Prashant, we're up close to around 90 points. The broader markets as well, keeping in pace, and advanced decline ratio, 5:1.
Oh, absolutely. It's a good-looking screen overall, and we're up 90 points, as you said. 20,085 is where we are at. So almost at about 2,100 now. If we can have these names up. So IRFC will come up on your screen. It's up another 8%. I mean, oh boy, what a run it's been having. And that continues unabated. This week, we're up 20%. This month, in a month, IRFC is up 80%, 85%. So I think this one I can safely use the term Euphoria, I think, at least for this one. I don't think anyone will fault me for this. IRCON is another one, which is up 7%. So 171 on IRCON. Look at that one go. It's, again, a big mover. It's up 50% this month, right? So it's not as if this move started a month ago, but sometimes what happens is stocks do well and they pick up pace. After doing a lot, they pick up pace even further. So that is something we're seeing here. ITI is coming up with an 8% pop out of the blue. I mean, but big volumes, and that's why it's coming up on my list here. PSU banks, Bank of India, Union Bank, Canara Bank, they all did very well. And I think that's the case this morning once again. So Union Bank is up another 4%. Bank of India is up another 2.5%. So that PSU theme, right? Central Bank is up 3.5%. Indian Overseas Bank is up 4.5%. So yeah, a lot of PSU bank stocks. The index itself, the PSU bank index itself was up, I think, about 2.5% yesterday by close. So gains continuing in this part of the market. Gati, there was that business update, I think, which came through yesterday. The stock was up yesterday. It's up another 3.5% this morning. KNR Construction is another name. But I mean, then volumes start to fade out if I start to go down the list here at this point. Some of the shipbuilders are seeing some pullback. So Mazgaon is down 2% and Cochin Shipyard is down about 2.5% as well. Praj saw that big 13-14% move yesterday. And we are down about 1.75% there. Bombay Stock Exchange is another one which has done phenomenally well. I think almost got to 1400 yesterday. It's down about 1.5% right now. BEL is down about 1.6%. Laurus Laboratories, there were some brokerage calls on these names. Laurus is down about 2.5%. TVS Select, I think, is another one which is down about 2% or so. IEX is down 1%. Tube Investments is down about 2.5% and so on and so forth. So this is the overall picture. 75 points higher is where we stand at this point in time. So it's a pretty good, healthy-looking screen. Atul Suri is now joining us. He's Chief Executive Officer at Marathon Trends PMS. He's with us here in our studios. Atul, good morning and congratulations, 20,000 on the Nifty.
Look at that smile. When milestones hit, you can tell on their face, right?
I mean, been there for so long, it keeps happening. Yeah, so it's good. And I think there are a lot more to achieve.
Is there a tinge of red on your tie, or that is something
You
else?
also have a red tie.
Oh dear.
He's the only man in green.
It's his birthday today, by the way.
Oh, the evergreen man.
How's looking, Atul? How are things looking? More set for more?
I think so. The fact is that, everyone's got a lot of red flags up. But essentially from what I feel where the market is heading or what my targets were, I see that there is still more upside going ahead. As I said, there's a lot of panic, there's a lot of talk of bubble and there's a lot of talk of all that. I don't think we are anywhere near bubble territory. I think there's a lot more to go. And when trends play out, when they get into this kind of stage, when they get parabolic, really nobody knows the top.
Yeah.
In stocks, in sectors, we do mention names and you say 80% up, blah, blah, blah. Who knows, Nobody knows. And
Are we in a
shows.
parabolic phase, you think? Because parabolas also happen towards, they're late stage phenomenon. They don't happen early or middle.
I don't know about parabolic. Maybe some parts of the market are in parabolic stage. But overall, if you look at the index, now, if you look at the Nifty, okay, there's so much talk, new high, etc. What are we up year to date?
Nifty, I completely agree.
10%, yeah.
11%.
I was looking at returns from the 31st of March. Nifty is up 18%.
Yeah.
But we got the small cap index, which
because
is up 45%.
Because you're taking 31st March, Prashant.
Because for...
You're choosing a very, very,
I was making this point yesterday.
Go year to date. Go 2 years. Okay, 2 years to date. Tell me what is Nifty up? It's up 15, 16, 17%. On a 2-year basis, it's not much. It is what, 6, 7% year on year.
No, I'm saying even compared to from 31st of March, even then, I'm saying compared to the broader markets, Nifty, I completely agree. Nifty is not done very much at all. Okay. But you think gains will pick up there on the large caps?
I think so. I think that there is more upside. And what I say is that you've seen 11% and you're getting this thing, that we can have another 8, 10, 9, 10%, And a lot of people say that, you want to sell out this segment, we should get out, blah, blah, blah. You never know. You could be missing a more interesting part in the market. So I feel that we are not there yet. I feel that we are in a process. And at the end of the day, we are going to have corrections in life. We've seen so many corrections. We saw COVID, right? Recent memory. It was horrible. And nobody even talks about it.
But it was, in hindsight, the best time for retail investors to put in all their money, right?
Absolutely.
If there is one phase where you sell your home and put in the stock markets, it would have been that time in 2020. But
it's all good in,
it's all good in hindsight, absolutely.
So just one thing though, this point, right, I completely agree, but in mid caps and small caps, right, we saw what happened in 2018. You got a top, and then it took years for some of those prices to come back.
True.
That is all I'm saying. Is there a problem? You get locked in and you are...
So let's address that question, right? So that's definitely the narrative on the street, that there's a bubble, euphoria, etc.
No, I don't think anybody actually is saying... I think I heard from Kotak yesterday, where there was a note saying that we're dropping coverage because, we can't find value except financial. So what's the point of having... But apart from that, people are okay. What's the risk of getting kind of stuck right? Because mistakes also happen in very euphoric kind of markets. You've seen that.
Absolutely.
So what's the risk of that?
So there were these numbers being put up like that, let's say Nifty is up 10, 11%,
Yeah.
small cap index up 30, 33%. So 1:3, that's big. So we do something called a ratio chart. A ratio chart is where we compare one index versus another, and it's not from a starting date. The risk is the starting date. If I take 31st March, everything is like at risk, okay? But what we did was we did a ratio chart and we realized that historically, we are nowhere near euphoric territory in the large cap to small cap ratio.
Okay.
So we were wondering that, hey, the mood is something else. The screen is telling us something else. But then you realize that for 2022, Prashant, the Nifty was up some 4-5% or something. The small cap index was down 14 to 15%.
Yeah.
Yeah.
So now if you move your starting date from 31st March to maybe 2 years, you'll realize that actually what the small cap is doing is catching up with the underperformance of 2022. So when you start seeing data as a more continuous flow, rather than a start point and an end point, you'll realize that in that ratio, we are nowhere near where we were in 2018 or 2008. You mean the euphoric level. In fact, it is just in the process of catching up the losses or underperformance of last year. Now, when you change the starting date of looking at data, the whole picture changes. So you can actually change a lot from starting. So I personally like to look at things on a more continuous basis because see, for all of us and for most investors, see, this is a process. Yeah. This is a process. There's no start point, no end point. No one's going to sell everything.
I think the million-dollar question is where are we in the cycle, right? Everyone's comparing this to the 2003 to 2008 period, and nobody knows.
No, I don't think we are nowhere near that. We are nowhere near the highs. In fact, we are midway. What I'm trying to tell you is that we are actually catching up the underperformance that small caps have had in 2022.
Okay, so you're saying you're nowhere near the highs, we are midway in the cycle.
Yeah.
But in terms of sectors, I want your view on banks because, while the Nifty is up 10% this year, banks have done nothing, I think 5% or something, the Nifty bank.
Right.
Do you see leadership emerge now from this heavyweight?
So the same question goes for banks, Sonia. 2022, what did banks do? In fact, banks were the thing that really pulled up the market. So banks were up, I think last year, some very large, it outperformed the Nifty by a big number. So the fact is that banks also are to some extent resting and they will do a catch up because see, at the end of the day, the numbers that are coming out of banking space are very good. What is sort of, perplexing is that after those numbers, how come we are not seeing those kind of stock movements? The major contributor to the Nifty earnings are banking. And why is banking not driving? So the fact is that banking had already run up in anticipation of these numbers. Now the market is looking for something incremental. And as I think as incremental stuff comes, I feel that banks will do. Look at NBFCs. Again, I'm stretching the definition of banks and financials. You'll find that a lot of NBFCs are doing very well. The NBFC index, if we had one, would have outstripped most of these guys by miles. Yeah. So I feel that, just because things have moved up, we need to really look at it not from 6 months point of view. Look at it from 2 years, 3 years point of view. Some things that run up like PSUs. Because PSUs didn't do well for a decade. Yeah. Ask anybody who's been in the market for 10, 20 years and all swore never to touch PSUs because so many times, you had stop starts and disappointments. And what actually PSUs is doing is what they have not or what they fail to deliver. So I think markets tend to be, excesses happen. It happens on both sides, then catch-ups happen. But if you view it as a process, I think as far as the process goes, I don't think we are at like a bubble top or something. Look at it in a longer term perspective, things are still promising.
Okay, good to hear that, Atul. And what about, the Nifty? I think when you joined us in the past, you have said 21,500. That's the target you're looking at.
Right.
How soon do you think we get there? We've got plenty of momentum with us, so I ask you that. And also the other one I want to ask you about Brent crude. That surprised everyone. Yeah. It's at around $90 per barrel.
I think I'll come to this question that's more important is because honestly, if you ask me that what can stop the market or what is my area of concern, I may sound bullish, but I also have some red flags or some area of concerns. And that for me is US bond yields. The last time US bond yields at that's 4.25, etc. The US markets, the S&P 500, that's I think October 22, were at 52-week lows. So you realize that there is a tendency of bonds and equities to be inversely correlated. Bond yields have again gone back to 4.25, 4.3. In fact, they're nudging to make new highs. And equities continue. So my big risk or my big concern area is actually global. Because if bond yields take off, we all felt early that, okay, this is kind of the peak of the rate cycle is there behind us. and now the Fed would start cutting by the end of the year. Now we are almost approaching the end of the year, and there is talk of maybe further hikes. So what I'm trying to say is that the narrative that inflation has peaked out, bond yields have peaked out, that is getting pushed. And if that re-emerges, if the Fed gets a little more aggressive, or inflation starts popping up, where crude energy is a very big input of inflation in terms of the kind of price moves that there are. I think that is, so if there's one concern area that really that bothers me is the way US bond yields are shaping up, the way even some of the commodities are shaping up. At 90, if crude gets to 100 and all, things can get uncomfortable. And I think the narrative, if it changes globally big time, I feel that can actually be a dampener for our markets.
I just want to quickly put out, let's have the intradays for mid-cap and small-cap indices. We're seeing a very sharp move on the way down for these two indices. I mean, not usually can they start higher and then move higher for the rest of the day. But look at that. This is just today, I think. Yeah, this is just today. So from the day's high, it's a bit of a fall pullback, and I think on the mid-cap as well, similar kind of price pattern. So just FYI, just watch that as we go along. On the Nifty, we still got about 60 odd points or so. Atul, in terms of sectors and where one will make absolute returns from here on, which are those spaces?
I still think that the things that are linked to, your capital goods, engineering, electrical equipments, we've been talking that's the way we are positioned in our PMS. It's more domestic driven. For many years, the market was focused on those few stocks, which definitely were outward focused, export, some of the large IT names, or some of the very high quality names. I feel that trend has really changed in the last few years. I think that the whole thrust or the whole emphasis is going to be more on domestic facing. When the world is looking towards India and where growth globally is a little questionable, I feel that domestic driven sectors, and as I said, we love electrical equipment, they're moved up, we know that. We like engineering, we still like defense. So wherever these stocks are backed by numbers, because that there is never a compromise on. If they're backed by good earnings and numbers, yes, they may have gone up, but I don't think that the party is over. I still think that there is a more upside remaining. So that's the kind of view that there is. So I'm just trying to share with you that, hey, you know what, it's not that we are in bubble and it's over, you should sell and exit. It's a process. It's a process. The markets can correct. Yeah, they can correct 3-5%. Things will happen.
And that's healthy. It's always healthy.
But when you look at, you're talking about India's decade, etc., etc., you realize that these are going to happen. Yeah? And in our life today, we're 20,000 and celebrating. How many times we've seen the market down and pessimism, etc. But net, I think
you move on. Yeah,
you move on. And
at
the end of the day, all these targets that we give, the number is not so important. The important part is the direction. And if your direction is right, if you're invested, you're invested in the right stocks, I think that this is probably one of the most interesting, best investments in this country.
Okay, as they say, time in the market is more important than timing the market.
Time, and also I think you've got to play it well. You have to have a process here. So, even time in the market, 2,000 stocks have got delisted here. So if you had a lot of patience with them, you would have got killed. The important thing is the process.
I just want to mention, by the way, since we're talking about, this bull phase and everything, the mid-caps are in the red now. So a little bit of caution is always good, right? I mean, the index is down 120 points, the mid-cap index. It's down about 0.2%. So just want to pull up that index for you. But there is...
By the way, he said, what do you say, when to hold it? I was reminded of Nigel Kenny Rogers.
Which one is it?
Gambler. Know when to hold it, know when to...
What are these archaic songs that you guys listen to?
His generation. His generation.
Generational gap.
Rogers, wow.
Okay, but there is definitely a FOMO feeling amongst the retail investors, right? Now when you step out, people are talking about, 20,000, but I missed out, what do I do? At this point when retail starts to come in, what is your advice to them on people who've missed out on the rally?
No, it happens. Clients call up for top-up, new accounts. But the fact is that, as I said, that it's about the direction, Sonia. You have to accept that you will come in, yes, at these levels, the risk reward is not what it was 6 months ago. The risk reward is not what it was 6 months ago. But the fact is that if you're able to stomach a little bit of volatility, maybe there's a 3%, 5%, whatever, it can happen at any points in time. But more important is the process. The more important is the direction. The more important is that we are at 20,000 after correcting 30-40% 2 years ago. So I feel that if you are mentally prepared and have a process for equities, it's a marathon. It's a marathon, simple as that. It's not a sprint. And that's what most people view it, most people retail. But then they go through it, they get burnt a couple of times, and then they realize what investing is all about. So I strongly feel there's a process. We are a part of the process. I don't think we are at the top.
Just choose good shoes. I mean, good stocks, right? I mean,
For the
that's the
marathon.
only thing for the marathon, and I think you'll be fine.
Save your knees.
Thank you very much, Atul, for joining us.
Thank you
It's a
much.
pleasure
Bye-bye.
having you with us
See
here
you. Thank you.
on the program. Well, in line with getting you more opinion on markets, we have someone who looks at India from a slightly outside perspective. So now we have Rahul Chadda, Chief Investment Officer at Mirae Asset Global Investments, joining us. Now, Mirae has about actually closer to $6 billion in Asian equities, and they've got a little over $1 billion in Indian equities invested. Rahul, great to have you with us here. Pleasure. I want to start with what we were talking with Atul here. Are things in the mid, small, and actually especially micro caps getting a little overheated and a little overdone, in your opinion?
Absolutely. Again, look, we all believe in the resilience of the India story, and it has been an overweight for us for last 5 to 7 years. What the policymakers have done over last 7 to 8 years is commendable in terms of the digitization, in terms of the infrastructure rollout, GST, etc. That's coming in the superior growth rates we're enjoying. And that kind of explains the resilience of the market versus what's happened in the rest of the Asian peers. But I think this move in mid-small caps, up nearly 35 to 40% since last 6 months, when globally Fed is tightening, balance sheet is contracting, would be a bit worrisome. And we've seen time and again. I think the momentum in India, it happened in 2007-8 also, carries a bit longer, but that would be a cause for concern.
So, the big question now is what do you do with mid and small caps, right? And the kind of money that you have made, perhaps. Would you look at moving out of mid and small cap stocks and back into large caps?
So again, that's something we've been doing since, I would say, last 2-3 months. Look at our mid-cap portfolio, some of these mid-cap names, whether it's hospitals, real estate, or other sectors. Look, we've owned them for 5-7 years, but look, valuations look kind of fairly full here. So what we're doing is top slicing probably 10-15% and moving that to large caps. So large caps which offer value would be financials, some select consumer, and even IT for that matter.
Rahul, but some make the point that, and Atul earlier was making that same point, that mid caps and small caps are actually only making up for lost time, right? After all, they started participating only from March. I mean, the lows in March. What's the pushback to that argument?
So if you look at longer time frames, let's say 5-10 years, and with, let's say, a nominal GDP of 10% plus, I'm sure there are going to be so many opportunities in small mid caps, etc. These small mid caps would eventually grow to become large caps, and that's what we've seen over the last 10 years. But along the way, there are going to be sharp pullbacks also. So it depends on the time horizon. If somebody's got a time horizon of 3 years and doesn't mind 20-30% pullback in small mid caps, then one can stay invested. But like the way we see in markets, so much of this position in market for retail investors is held through derivatives, and that's a levered position. I think there, if you get a 20-30% correction, it can wipe off a lot of gains or capital. And this kind of I would say, advice is more for those people who are levered, who are playing the options, rather than people who have a 5 to 10 year time horizon.
Okay. Any thoughts on something like HDFC Bank? I mean, despite the bank Nifty coming back in a big way, I mean, for the last couple of days, HDFC Bank continues to underperform. What would you do here?
So HDFC Bank, again, we all know it's a great company, and I think somewhere this is the merger or the consolidation kind of an thing which is kind of going through as banks tries to build up the low cost deposits. That's where a bit of an underperformance is coming. Investors wait for better clarity on execution, but fairly confident that in next 2 or 3 quarters, as the bank catches up on growth with peers, as the bank kind of provides for some of these assets from the legacy mortgage book, etc. Again, the underperformance should be a thing of past.
Underperformance in HDFC Bank should be a thing of past. Got that. Rahul, apart from HDFC Bank in financials, right, since that's about 40% of the Nifty weight, what are your top ideas?
So we continue to like ICICI, HDFC, Access, the private sector banks. I think this is where we would be, and selectively once we have a reasonable amount of corrections, or once there is a clear visibility of interest rate cuts, one can look at NBFCs also. But our view here is that near term we'd be cautious on markets because look, RBI is not going to ease till the time Fed eases. Most people are expecting easing to happen somewhere in 23. I think it's more of H2 2024 story. And that's where markets are vulnerable to pull back. And look, Nifty has a close correlation with the US markets. And as US markets kind of face this pressure of slowing economy, kind of a weak earnings, and then continued Fed tightening, I think those markets are ripe for a pullback. And should that happen, that's going to translate domestically for the Indian markets also.
So your view is that global equities and US equities in particular are due for a bit of a pullback? Is that how you're thinking?
I think over next 6 months, we'll see a pullback in global equities. You look at the economic data which is coming out of Eurozone, that's a fairly weak data. US also, if you look at the employment figures, I think those numbers have been revised downwards. The money supply is kind of collapsed, fairly weak for the second quarter. So all that is going to result in weak economic data and earnings for US, and that's where the markets there are vulnerable for a pullback. And a similar thing translates into weaker export growth for India also. Clearly, there's a pressure on exports, and RBI is mindful of the trade deficits and would like strong macroeconomic stability. So it's unlikely that we have rate cuts in India before US starts cutting rate. So I think right now the narrative is all about inflation peaking. I think over coming months, the narrative is going to change to that economy is slowing very quickly and policymakers are not doing enough. And that's where markets become vulnerable, particularly in the small mid caps space where there's a huge euphoria. Markets become vulnerable to a correction.
Got that. Rahul, so basically what you're saying is that from the current complaint, which is that the economy in the US is not slowing and hence inflation is still too high and more needs to be done there, you're saying very shortly the complaint will change to the fact that the economy is slowing sharply and central banks, especially the Fed, is keeping rates too high. The narrative will shift shortly. Is that's what you're saying?
I think the narrative or the complaint is going to change to that policymakers were behind the curve when inflation was there. And now when the priority should be restoring back growth, the policymakers are again behind the curve. But to be fair to policymakers, see, it's hard for central bankers to cut rates when almost every second week you have some union in the world which wants to go on strike demanding higher wages. So you look at what is happening with this, again, automobile unions in US, you look at what's happening in Korea in terms of these unions threatening to go on strike. So I think central banks are going to wait for clear signs of slowdown before cutting rates. And that is where markets will get worried that, look, the easing which we are expecting and the growth revival which we were expecting is not coming fast enough.
And the rate cutting cycle will only present itself properly in the second half of next year. That's what you're saying?
Absolutely. I think unless or until we have a big event, like the way it happened with the regional banks in the US in Feb, it is unlikely that Fed is going to cut before next year. And look, if you look at the rupee US rates differential, that's the lowest it's been, and same is the case with most emerging markets with the US. So with that as a backdrop, what we see domestically also in India is most Indian corporates kind of are repaying overseas loans, borrowing locally. So liquidity becomes tight over there. So any prudent central bank would be hesitant to cut rates in this environment when the rates in US are sticky.
Rahul, let's talk about consumer demand in India. Now, leaving aside the top-end consumer, consumer spending arguably has been kind of weak. You said that you would look at select consumer stocks here, large caps. Talk to us about this particular space and the opportunities you see.
So clearly, investors and the companies also are trying to fathom that what is the reason for the slowdown. So leave aside the top end consumer. I think that consumer is enjoying the benefits of a strong asset cycle. Real estate has done well, stock markets have done well. So that consumer it's in own world doing relatively insulated. But at the middle or a bottom end, I think somewhere the consumer was squeezed by what happened around COVID. People lost their jobs because a lot of the unorganized sector was in pain. After that was an inflation surge, so that impacted. That consumer has not been able to come back, and I think the hope is that in coming quarters, as the economy does well and the pressure of inflation eases, that consumer demand would come back. But it is to be seen. So I think people are looking at this Diwali or the festive season very quickly, but very, very closely, I would say. But it is to be seen when that bulk of the consumption demand comes back.
Rahul, it's a pleasure. Thank you very much for joining us with all that perspective. Really useful to hear it from you as someone who's invested in these markets for such a long time. Appreciate it. I just want to highlight what's happening in the broader market. It's actually a real hard knock. Let's have the small cap index up first, if we can. It's down 1 3/4%. It kind of, it's eerie because for the last so many days, we've had, starting from Pankaj Tibrewal a couple of days back, yesterday, actually all of them, Sunil unambiguously saying that maybe, Sunil Singhania, that is of Abacus, saying that he'd move to large caps from mid caps, at least, incrementally from here. It's not a sell call or anything of that sort. Vijay Kedia sort of advising caution. And you also had Nilesh Shah, of course, making that same point, like Pankaj from Kotak earlier. And of course, Rahul unambiguously saying that for the last 2-3 months now, they've been trying to move a little bit into the large caps where there is more valuation comfort after the run-up that we've seen. Look at that. Almost a 2% cut now on the small cap index. And I just want to use this opportunity to talk about stocks, right? It's a sharp reversal. Let's start with RVNL and let's have the stocks up. RVNL is at about 177, which means it's down 6% on the day from yesterday's close. It's down, I think, over 10% from the day's high. Look at Mazgaon Dock. It's down 5.5% from the 5.5% today, and I think down almost 8% from the day's high. Look at you got Cochin Shipyard, which is down 7%. Cochin Shipyard will come up on your screen. There is Bombay Stock Exchange, which is down 6%. These are, mind you, these are large cuts for a single day, and we're early into the session, but the point is they've done very, very well. I have to have that context. Railtel is another one which is down 8.5%. It'll come up on your screen. There is GMDC, which is coming up with a 6% cut, 273 on GMDC. Garden Reach is down about 6%. Stocks at about, 843. Garden Reach Shipbuilders. There is NBCC, which is down 5%. Bajaj Hindustan is down 9%, actually almost a full 10% right now. Tube Investments is down 5%. Shipping Corporation is down about 6%. Texmaco Rail is down about 8%. HCC, Jupiter Wagons, HBL Power, and so many others, which are easy down between 5 and 7% or so. And the market breadth, overall NSE market breadth is completely swung the other way. So if you can have the NSE advanced decline ratio, you'll know what I'm talking about. So yeah, there you go. Look at that, crisscross. And it's very dramatic. 2,300 stocks are down and about just under 500 stocks are actually higher at this point. Sonia.
If you look at the valuations, right, the Nifty is currently trading at 20 times current PE and the 10-year average is about 18 times. So the Nifty is still slightly higher than its 10-year average. But look at the small cap index. It's trading at 20 times currently, the PE, the price to earnings, and the 10-year average is around 16.5 times. So there is absolutely no valuation comfort in the small cap index. Even in the mid caps, the mid cap index is trading at about 25 times compared to its 10-year average, which is at 20 times. So there is a lot of valuation discomfort in mid and small caps. And the only place where the valuations are below its 10-year average is the Nifty Bank. The Nifty Bank is currently trading at 14 times. The 10-year average is about 16 times. So just something to keep in mind that there is definitely some valuation discomfort here. But let's move on. M&M Financial is in focus. Disbursals for the month of August was up more than 17% on a year-on-year basis. The total assets have also zoomed 27%. Ramesh Iyer, the Vice Chairman and Managing Director at M&M Financial Services, joins us now. Mr. Iyer, thanks for joining us. In the month of August, the disbursals on a year-on-year basis went up 17%, but month-on-month it was flat. Just tell us what the trend is looking like over the next couple of months. And where do you think you can end the year with as far as disbursal growth is concerned?
So the best part of the year is yet to come, right? I mean, the festival seasons are the best part of the market that we work in. And again, historically, we've seen the second half is far, far superior to the first half. So I think the best is yet to come so far as we're concerned in terms of disbursement for future is concerned. Year on year growth obviously is very, very good. For the first time, we are seeing even in the first half is
I can't hear you very well. I think there's some issue with your audio. So I'm just going to try and repatch that line. But you're saying the best is yet to come in terms of, disbursal growth. So on the back of this 17% growth that you've seen in disbursals this time, I'm interested to note, to understand from you what the growth will be for the full year. So just trying to look at that. Year to date, actually, disbursals are up 23%. I think he's back with us. Mr. Iyer, I couldn't hear that final part, but if you're saying that the best is yet to come for the business, what are you looking at by the end of the year? Because year to date, disbursals are up 23%. You're sitting on a base of around 21,000 crores. Where do you think you can end the year in terms of growth?
No, so far as growth rate is concerned, last year second half was also a good second half. So therefore, the growth rate could probably still be around the same percentages. But I'm seeing in terms of comparison between first half to second half, you will see second half growth will be much higher than the first half growth. And the festival season is yet to open up. The monsoon is catching up, so I'm reasonably sure that will end up positive. Put the two together, I think the rural market will definitely show positive sentiments for the second half growth.
All right. Mr. Iyer, do you want to put a number to it for the year?
So if, as I said, the growth rates would be similar to what we have been seeing. So, and if you look at our last year's disbursement and then you apply this growth rate, that's the kind of growth we are talking of.
But give us that number. Is it going to be mid-teens?
Very easily.
Is it better than that? I mean, just looking for a range at least.
I don't want to put a number out there because, at the end of the day, we are enablers to the sales that happens from OEM. The vehicles need to be available.
Got it.
But reasonably, everything looks positive.
Okay, I particularly ask you this because the monsoon has been subpar. That could affect the rural economy on the whole. Are you seeing signs in terms of cash flows getting squeezed out a little bit? Give us your sense, because the monsoons are subpar, that's a given. Your take.
No, so if you look at our August collection efficiency was at 96%. And August did have, lower monsoon, and there was so much of discussion around that. I repeat myself, I think the sentiments are holding up. And if you look at September, I think many of the markets, whether it's Bihar, UP, parts of Maharashtra, the monsoon has caught up. So while it may end up a little lower than original expectation, but I think it's sufficient enough to have a good yield, and therefore we don't see it as a negative going forward.
Okay. You were talking about how you'll maintain the same kind of growth that you've seen so far, right, in terms of disbursals. But the incremental growth, do you see it coming in from a lot of the new geographies? If yes, which ones? And also the volumes that you're getting in terms of incremental loans, is it from your newer product offerings, whether it's, SME, the LAP, on the digital side as well? And are you seeing an increased share of pre-owned cars? If you can just throw some color on where you're seeing the maximum amount of traction from.
So as far as geography is concerned, I think we are seeing a very uniform behavior across the country. So it's not a geography-specific approach. But we got into the primary segment of the vehicle, which is a little high-end segment customers in these markets. And we've been gaining some market share there. Currently, about 12 to 13% of our book comes from, or the disbursement comes from the primary segment. And that's something which is right. I think the pre-owned vehicle demand is holding up extremely well. In fact, the supplies are constrained even in pre-owned vehicle because repossessions are lower, therefore the supply is not available adequately. Once you see some traction there, I think pre-owned vehicle will definitely drive growth for us. So for as SME is concerned, it's still about 5 to 7% of our book. So that's not really a big growth driver in as far as disbursements for this year is concerned. But on the vehicle front, Primex segment, pre-owned vehicle, and gaining some market share in our segment that we are in, the three which adds up to what we're talking about.
So this pre-owned vehicle segment, can you tell us, I'm sure this will also support your yields, right? The pickup that you're seeing in pre-owned vehicles. So what would this be as a contribution to your overall business? And what would the AUM growth look like over there compared to what you've seen in the past?
So I think, if you look at a 1 year plus kind of a thing, we are talking of 15% plus of the book coming from pre-owned vehicle. And this year particularly, you will see it go to 10-12% kind of the book. And definitely they come at a better yield, and that improves the overall yields for us.
Okay, all right. Mr. Iyer, more in terms of a strategy question from here on, how much of your book is captive finance that's coming in from the group itself?
No, so about 45% of our book has always been Mahindra product, which is tractors and all of that. And we continue to stay there.
What's the strategy? Going ahead, do you think that you'll reduce this dependence? Do you expect it to hover around these levels itself?
I don't think so. We want to consciously reduce that. We look at the market share that we have for this product. As far as the autos are concerned, we have a market share of anywhere between 30-32%. And for tractor, we have anywhere between 28-30%. I think we're comfortable at that market share. And with the overall volume from all the OEMs remaining what it is, we don't see this composition change substantially.
Okay, all right. What about the focus and investments in collections? That's the other part that the street is looking forward to. Could you tell us the initiatives, the kind of investments you're making out there?
So if you look at last about 2 years, our collection efficiencies have been pretty high. Our gross stage 3 has substantially come down, and therefore the net NPAs have remained at about 2% kind of a number. And that's at the back of excellent cash flows in the market out there. But more importantly, we've also kind of got into different approaches of follow-up, in the sense bucket-wise follow-up, giving a lot of digital capability to customers to be able to repay. But at the end of the day, the collection is an outcome of a good cash flow on the ground out there. And every activity level we are seeing, whether it's tourism, we see infrastructure, we see the farm cash flow, the people movement. I think all fronts, the cash flow is pretty good. And that's reflected in the collection efficiency as well as in the GS3 and stage 2 reduction.
All right. By the way, I just want to point out that there is big profit taking that you're seeing in the market as well, not just in the mid-cap end of trade when it started, but now that's extended to the frontliners too. I guess it's par for the course, because generally, when markets hit these psychological levels, milestones, there is some amount of profit taking that you see, and there's caution in the system in mid and small caps as well. There is a bit of froth, maybe euphoria if you'd want to call it that. So a little bit of money being taken off the table, but now it's getting steeper. So the Nifty is down almost 80 points. And look at the mid caps, almost a 3% knockdown over there. Mr. Iyer, just one final question from my end. Your net interest margins in the last quarter had dipped to an 8-quarter low. And at that time when we spoke to you, you said that your long-term margin guidance stands at 7.5%. Are you on track to hold that, or do you think that there could be some pressure before, the margins recover?
So the net interest margins are an outcome of three things, right? One is the borrowing cost still remaining where it is. So no sooner we start seeing the borrowing cost starts to come down, since our lending rates are fixed, you'll start seeing improvement to margin. Two is it's also an outcome of a product mix. As I said, we've increased our product mix when it comes to the Prime-X, and they come at a little low rate, but they also come at a low cost of operation and low credit cost. Therefore, at the ROA level, we won't see the pressure. And the third is, as we start improving our pre-owned vehicle numbers, you'll start seeing improvement. So therefore, on a little 1 year kind of a range, if you look at, we are holding on to our net interest margin levels of 7.15, 7.2 kind numbers. Temporarily, you see this dip because of this mix. And as the rate starts to correct, you'll start seeing the benefit. There is a 20 basis point lag that we are yet to pass on to consumers, which we believe that we would do so in the next couple of months.
Okay, well, Mr. Iyer, we'll leave it there. Thank you so much for joining us. And it's always a pleasure having you with us here on CNBC-TV18. You got the market, which is down 72, 73 points now on the Nifty. And you got the Nifty Bank, which is also corrected sharply. The index will come up a 0.25% lower on the Nifty Bank as well. That is about 120, 121 points. But this compares, this is nothing compared to the 3.5% cut on the small cap index. 3.7% cut on the small cap index, and the mid cap index will come up. That is down about 2.5% as well. So, yeah, incredible rallies and a bit of a pullback, which is coming through. Actually, not a bit of pullback for a single day. These are sharp reversals which are coming through. So, let's watch this in terms of how this develops from here on. We'll take a quick commercial break here. Rahul Sharma, Director and Head of Technical and Derivatives at JM Financial Services, will be joining in on our special segment, Charting Trends, and I think it's pretty opportune time to talk to him about what's going on and what we're seeing out there on the screen. Stay with us.
Welcome back. Well, the markets did take a bit of a knock, but if you're looking at the Nifty itself, there's been some bit of recovery as well from the lows. So, just if you pull out the lows from the day, I think it's moved down and recovered close to around 50 points off the day's low. So that's encouraging, actually. So we've defended the lower levels. I think 19,920 odd. That's the level from where we pulled back in the last few minutes or so. But as promised, Rahul Sharma, Director and Head Technical and Derivatives at JM Financial Services, joins us on the show. Hi, Rahul. Good morning. Thanks so much for joining in. Well, today a bit of a down day, or maybe some kind of profit taking from the top. But the uptrend, you would say, is still intact? If yes, how do you approach the headline index?
Yeah, good morning, Nigel. So probably the party in the mid and small caps has, just ended with the cut today. We have very boldly given a switch hit from small caps and the lower mid caps to the large caps. I think, what would happen in weeks has happened in days as far as the Nifty movement is concerned in the last few days. But the re-entry point, if somebody has missed out this rally, could be a minor dip that we are expecting from these levels. So we've gone from 19,400 to 20,000. 19,800, maybe 19,650 best case scenario seems to be good levels for re-entry for the rest of this month. And the next leg of the rally that happens, we are expecting Nifty to test 20,432 on the upside. So I think this is still a bull market. This is still a very strong primary uptrend. September is expected to be, bulls favorites, if I may call that, and dips are to be bought into. So clearly look to re-enter at key support levels and clearly book profits in mid caps and small caps, where we've seen a phenomenal rally happen in the last few weeks.
Okay, book profits in mid caps and small caps, but otherwise you stay invested in this market for the long term, right? That's the view. So in the large caps, I think the common narrative now, Rahul, is that move your money out of mid caps and small caps and into large caps. So within the large caps, where do you see the leadership emerge from?
Yeah, so we feel the new leadership, we've seen IT remain very strong, but the new leadership is emerging, especially from the banking led by PSU banks. So we feel PSU banks can do well. You have financial services, which was negative, has turned positive in this month. And lastly, the energy sector has seen a revival of buying interest. So, two pain points in the previous month. One was the banking and financial sector has now turned positive. And you had Reliance, which was under the pressure previous month, which was keeping the index low. Both of them have turned positive. So broadly, I think it would be a rally where the index heavyweights do well. We are expecting both the banking and financial services index to sort of reclaim their previous highs, and at the same time be selectively bullish in terms of the index components as far as the laggards are concerned. So, clearly, the Nifty 50 space is our favorite bet at this point in time, led by these top three sectors.
Okay. If there's a bullish outlook for the Nifty and the Nifty Bank, you want to help us with any individual stocks that you like, where you can either have a positional trade or where you see a bullish trend for the near to medium term?
Yeah, so a couple of stocks. One stock that we like on the banking space is IndusInd Bank. It is one of the relatively stronger private banks in the space and can easily see another round up move of around 8 to 10% in September. On the auto space, Tata Motors is one pick that we like. It has completed its correction, and now we feel that the stock is ready to get into a new trajectory, possibly around the 700 plus mark. So Tata Motors on the auto side, and lastly on the PSU bank space, Canara Bank looks pretty solid. In fact, it is a high beta play as well, and can see itself heading towards a new life high and possibly around 10% upside from current levels. So selectively, from the PSU banking space, Canara Bank is our top pick, followed by the likes of SBI and Bank of Baroda. So from
Yeah, go ahead.
yeah, so one thing that we like from the consumer durable space is Havels. In fact, Havels has seen very aggressive price action on Friday. After that, it's seen a bit of a cool off, but it is a multi-month breakout that we've spotted along with a very strong expansion in volumes. We could very well see the stock heading towards 1600, even 1800 in the next 3 odd months or so. So a massive breakout is at play in this stock, particularly from a monthly time frame, and investors can participate this up move, by buying it in delivery.
All right, Rahul, crude oil prices spiked up and a couple of stocks, could get hurt. That's Indigo as well as Asian Paints. But now, in fact, maybe crude oil prices are topping out. If that's what you're factoring in, then do you think it's a good time to buy into both these two names?
Yes, absolutely, Nigel. So crude oil has lost steam in terms of the up move. So technically speaking, Brent oil has given signs of bearish divergence. What that means is we could see a pullback in crude oil prices, which means the typical favorites which benefit from lower crude oil prices. One is Indigo and second is Asian Paints. And especially with the festive season coming up, especially with the T20 the Cricket World Cup coming up, we could very well see the aviation sector do very well. So we are very bullish on Interglobe Aviation from like a 1 month perspective. At the same time, Asian Paints could also see a revival from current levels. So crude related, I think these two are the bargain picks which can do well going into the next few weeks.
Okay, all right. We'll leave it at that. Thanks a lot for joining in and giving us, an update on how the charts are looking and the way forward from here. So the summary is that if you're sitting on mid and small caps, perhaps it's a good time to take profits. But for the larger caps, the runway, it's a long runway in this market. Let's slip into a quick break.
By the
on
way,
the other side.
Sonia, the Nifty's come back into the green.
Yeah, yes. It has.
So yeah, it's up about 2 points basically, and it's a sharp sell-off and then a sharp recovery as well, but absolutely flat. And I think the mid-cap index is also recovered. If you can have the chart up, the mid-cap index is recovered, I think, about 1%, and the small-cap index actually is recovered a little bit more. They're still down, but they've recovered from the day's low. This is still, the early part of the innings today, so there is a fair bit to go, but down from the day's high still substantially, but down from the lows as well, which I think is, heartening at the margin.
On the Nifty, Prashant, yesterday you saw the 20,000 put had a fair bit of open interest. The premium out there was around 80 to 90 rupees. So those that were writing that particular strike, 19,910, 19,920 was very important. We have gone down to 19,915 and bounced off that mark. So in the near term, that becomes a bit of your the level that you're looking at. 19,900, 19,920 on the downside, and that's precisely from where we bounce back today. So just keep an eye out on that level if you're trading the index itself. For the time being, we'll slip into a short break. You come back, we'll focus on the commodity markets. You stay with us.
All right, shifting focus to the commodity markets. Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
Well, Sonia, I'm looking at zinc because overnight all the metals have seen strength, but zinc clearly gave you an outperformance. 2% of gains overnight on a week basis. On a month basis as well, we've seen 7% of gains come in for the prices. It's trading at a 3-week highs, not too far away from its 5-month highs as well. And the support comes in as China has refined imports up by nearly 76,000 tons in the month of July. We have seen stronger numbers, by the way, come in from China, and that clearly has been supportive constantly in the last month or so. So the China refined imports are highest since April 2019 from where they stand. And when you look at the import numbers itself, if you look at 2022, it was much lower at 79,000. 2022 has been a stronger number, and 23 clearly has seen a bit of a jump there. So even as China production has been increasing as well, the Chinese imports have been on the higher side, and that tells you that the on-ground demand, which is trading in backwardation right now, is looking back at premiums. So when you look at the Shanghai stocks, we have seen support coming from there too. Shanghai stocks have been constantly declining. We stand at 43,000 right now, which is much lower than the March peak, and last year April was even higher. So as you can see, the Shanghai stocks are really minimal at this point in time. Take a look at the LME warehouses, which are holding strong, but here as well the devil is in the details because the cancelled warrants stand at 64,000. This is that quantity that is already booked for outpay. So even as the number is strong, we are looking at here as well outflows from LME inventories also staying on the stronger side. Now, the next number is the Chinese refined zinc output, which has seen a decline in the month of August on a month-on-month basis. But the first 10 months of this year have seen 10% of gains in sense of production. So China really seems to be picking up on production. Europe, the numbers are still on the weaker side, and that could be supportive for the zinc prices going forward. The last chart should show you on how the prices have been in 2023 till now. We started this year stronger at 3,000. In the month of Jan itself, we went to 3,500 and then a sharp fall at 2,200 in the month of May. From those kind of levels, we seem to be picking up quite a bit. But even on a YTD basis, we are trading in the negative month on month. And from the lows of May, we are in the positive right now.
All right, Manisha, thank you very much for that. That's the commodities picture as things stand right now. Well, I think people will be keenly watching the happenings on the market front. So it's like the Nifty is like a traffic signal blinking between green and red, and we are absolutely flat. It's just been not even an hour, and we've seen such a large move down and then up. So fair bit coming through. We'll take a quick commercial break here. On the other side, our special segment, Indianomics. My colleague Lata will get chatting with an elite panel to decode the ambitious India, Middle East, Europe economic corridor, which was announced at the sidelines of the G20 summit. So that conversation, we'll take that forward. Stay with us.
Welcome to Indianomics. Among the announcements in the G20 that got Indian stock markets excited is the IMEEC, or the India, Middle East, Europe Economic Corridor. The plan under this initiative is to connect India and Europe through the Middle East. It envisages a network of rail lines in the Middle East which connect India and Europe on either sides by sea. The intent is, one, to encourage more trade, two, to provide green infrastructure, and three, to be a counter to the Chinese Belt and Road Initiative, which had led to rising Chinese influence. Now, the announcement of the economic corridor became a tailwind for Adani Ports, actually, the stock markets on Monday, since that company has already acquired the Israeli port of Haifa. But how much should we expect from this initiative, and how quickly? I have with me an elite panel who would know a thing or two. Ambassador Navdeep Suri, former ambassador to Egypt and UAE, among many other positions. Mr. Rahul Chabra, former secretary, economic secretary at the MEA, and he has been ambassador to Somalia and other countries in trade relationships. And we also have Somnath Mukherjee, who is the managing partner at ASK Wealth, who wrote a very interesting article in the Times of India. Gentlemen, thank you very much for joining me. Mr. Chabra, let me start with you, since you have been in the MEA as the economic secretary. If you can tell us, what is your first impression? Is it likely to take off very soon? Is this the start of something big?
Good morning, Lata. Thank you for having me on your show. Yes, it is a big deal, in the words of President Biden itself. I think it's a good way to start off. The important aspect to note and remember is sort of the geopolitical context, firstly. Look at the countries. Let's start with the ones in the middle. Saudi Arabia, UAE. And then Jordan and Israel are also part of the deal, though they didn't sign on. In Europe, the three biggest economies, France, Germany, Italy. Italy, by the way, is already having second thoughts on the BRI, which is the only European country that has signed on to it, of the G7. And on this end, India, and of course, all prodded by the US. So there is a huge geopolitical context in which this is being located. Of course, things have quietened down in the Middle East, and US was seen to be ceding space, whereas they are wanting to come back and become a big player in that part of the world. And what better way than to connect one of the fastest growing major economy, a democracy, India, to Europe. And in the slightly longer term, they're even looking at having goods move from Southeast Asia, another huge growth area, through India and into Europe. So it's a big deal which is happening, started being launched just now. It's been 2 years in the making, and it is now we have just seen the sort of initial announcement.
No, that's an important point that you said it is 2 years in the making. And Ambassador Suri, let me come to you on that. The earlier avatar is the PGII, or the Partnership for Global Infrastructure Investment. That was the G7 version. And even under that version, they'd already given some money to Indonesia during the G20 meeting in Bali. And they've also funded a $15 million health initiative in India. So would you say that it is good to go? There is already a core.
It's good to go, but from a different perspective, Lata. And that is that, you know, what you're looking at is a multimodal connectivity, that you will have a ship sail from Mundra or Mumbai. It'll go to Jebel Ali or Fujairah, unload its cargo onto railroads, trains that are freight trains that are ready to accept that cargo. And there's already a link, Etihad Rail, from Fujairah to the Saudi border. There's already a substantial part of a high-speed freight rail link in place from the UAE-Saudi border all the way to the Saudi-Jordan border. You have a missing link of about 300 kilometers within Jordan, which will be from the Saudi-Jordan border to the Jordan-Israel border. And then from the Jordan-Israel border to Haifa in Israel, there's already a rail link in place. So I would say that about 70-75% of the physical infrastructure for this is already in place. The remaining has to be built. But there are issues related to standardization of that infrastructure. Are we talking about the same gauge? Are we talking about containers of the same size, which can be carried seamlessly? There'll be work to be done on customs infrastructure, on regulatory frameworks that all countries sign off to. And once that is done, I think you might see it coming up sooner rather than later. I just make two additional points, if I may. One is that I think we need to think about it in terms of the entire conversation about building supply chain resilience. Currently, all our trade with EU, and EU is our second largest trading partner as a group, is via the Suez Canal. We saw what happened when you had that ship getting stuck in the canal. And it disrupted supply chains, and it sent panic waves through the international business community. This creates a handy little alternative to the Suez Canal so that you're not entirely dependent. Second, I think it's what the numbers that the calculations have been done. If on an average, it takes a ship 18 days of sailing from, say, Mundra to Piraeus in Greece, or to Italy, or to Marseille in France, this could potentially reduce the transit time to about 10 days. So it's a 40% saving in transit time. And the third is that imagine this not just as a transport corridor, but as a connectivity corridor, because they are also talking about fiber optic cables that will carry data. And they're talking about pipelines. In fact, there's a separate MOU between Saudi Arabia and the US about building a green hydrogen pipeline, which will export green hydrogen from Saudi Arabia into Europe. I was at this India-Saudi Arabia Investment Forum yesterday, and it was interesting to see Saudis present themselves as potentially the superpower for green hydrogen, given their 365 days of sunshine, abundant desert lands, and all of that.
Okay. So, Will, since you two gentlemen have been in ambassadorial positions in both these places, I just want to get from you, Mr. Chhabra, how quickly do you think that this last 300-kilometer rail link can come and trade can really pick up in this route?
You know, it'll take a bit of time. I don't think we should sort of jump the gun so quickly. I mean, they've given a timeline. I'm glad they've already set a timeline of 2 months for the senior officials to meet and sort of structure, because there's a lot of loose ends to be done, not just the physical infrastructure that needs to be built, as Ambassador Suri sort of hinted at. There's the regulatory framework, the customs input, regulations to be in place, sort of inspection. So lots of those sort of formalities also to become completed, and the funding. And of course, the Saudis have already put in $20 billion on the table. There will be more of maybe multilateral funding, private funding. Because once the political intent is there, the most important part is getting all these people on board as to be agreed on a concept. So once the big players, the EU, the US, India, the Middle East, everybody is on board as a concept, now the funding will start flowing, and then they'll have to structure it. So it will take some time still before the first goods really start flowing through this.
The funding, and I'm going to come to the tricky question to both of you in just a minute, but let me get Somnath in. He's written a very interesting piece in the Times of India, comparing it, or rather putting in context how Lord Curzon tried to build the Middle East and ring fence it for the British Empire to have a quick trade route to India. But Somnath, would you as a wealth manager, would you start putting any money at all in, say, Adani Ports or L&T, the likely beneficiaries? I mean, L&T already is building a lot in Saudi Arabia. All those green hydrogen projects Mr. Chhabra and Ambassador Suri are referring to, they're already in there. Is it a time already to think of it as something that will come up?
Yeah, thanks, Lata, for inviting me. First of all, I wouldn't be commenting on specific companies or stocks. But in general, is this an investable idea right now? Probably we are a bit too early for that. We have to see how this whole thing pans out, how the whole project gets delivered, conceptualized, and then finally executed. The biggest thing is that the biggest thing going for this project is essentially twofold. One is conceptually the point of China plus one, the same principles that drive producers from significant excess capacity in China, which has driven down costs for every consumer globally, to be reshoring it to various places, whether it's Vietnam, Korea, United States, and also India, at significantly higher costs for them, is what will drive this as well. There is a rediscovery of redundancy as opposed to optimization in trade, in business, in commerce. And we've seen time and time again, Mr. Suri mentioned about the Ever Given ship that blocked out trade on the Suez a couple of years back. We've seen the global financial crisis in 2008. That was a unique outlier example of how too much optimization nearly brought down the Western financial system as we know it. So there is a rediscovery of redundancy and the merits of redundancy in commercial and trade flows. And second thing that goes in favor of this project, besides the fact that some parts of it are likely already in place, like the Etihad rail, is also the constituent members of the project envisaged. Between the United States, India, and Europe, we have probably the best financial expertise and bandwidth available in the world. So unlike the other BRI, which is the Chinese Belt and Road Initiative, that fundamentally laid a lot of emphasis on the political side and got victim and became a victim of lopsided financial structuring. That risk is substantially lower in this BRI, which is the Boats and Rails Initiative, if I may use that expression for India. Because financial structuring should be high quality, high class, given the constituent members involved. Therefore, while at an investor perspective, it's too early to take a call because we have to see how it pans out. But from a larger long-term perspective, does this have a very high chance of success? Absolutely. And there will be opportunities for investors to participate in the months and years to come.
So not yet an investable idea, but a very good lead for future investments. But you all touched on the funding. Janet Yellen made it clear she will not even increase the capital of the World Bank or their share in the World Bank. Who is going to put money on the table? That question after the break. Viewers of Bazaar, you will get to watch it after market hours.
It's a day of consolidation after a heady run on Dalal Street. The Sensex and the Nifty give up morning gains to trade flat, but mid-caps fall much more. The Nifty Mid-Cap 100 Index drops by 2%. 90 out of the 100 stocks trade with losses.
Global investment firm KKR to invest over 2,000 crore rupees in Reliance Retail Ventures at an equity value of 8.36 lakh crore. KKR's stake in Reliance Retail will increase to 1.42%.
L&T is the top Nifty gainer in an otherwise tepid market after increasing their buyback price to 3,200 rupees per share from 3,000 earlier. Reduces the number of shares on offer to around 3.1 crore.
In the Sun, Unilever dips after cautious commentary by brokerages like Nomura, Goldman Sachs and UBS. Nomura says they expect a weak second quarter, while Goldman Sachs says they anticipate revenue growth to be muted.
L&T Finance Holdings is weak in trade after 7 crore shares change hands at an average price of 130 rupees per share. Sources tell CNBC-TV18 that Bain Capital is the likely seller, while Lupin gains in trade after entering a business transfer agreement with its subsidiary, Lupin Manufacturing Solutions, with a likely consideration of 750 to 850 crores in terms of the transaction.
Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me today is Ekta Bhatt.